Hello and welcome to this video module on leverage buyouts. What is a leverage buyout? A leverage buyout, also known as an LBO, is an acquisition in which debt is used to finance a significant portion of the purchase price. LBOs are typically enacted by financial buyers rather than strategic buyers. The leverage in the L in the LBO is typically debt, used to boost investor returns. We'll take a closer look at this notion shortly. Returns are typically measured as an internal rate of return or an IRR. LBO targets often share certain key characteristics. They have predictable cash flows. They often have a solid asset base. That asset base can be used to borrow against, and it's also used to deter competition to a business. They often have a defensible market position and either have solid management in place or have solid management put in after the LBO is enacted. Often a financial sponsor may have a management team that it wants to put into a business. LBO transactions include a number of key participants. They include the target management, whether in place or put in by the sponsors, the investment bankers who arrange the deal, financial sponsors who put up the money, and the various lenders. In an LBO, you'll have a number of debt tranches, such as traditional bank loans or term loans. You can have bonds, either investment grade bonds or high yield bonds, and you may have other levels of debt down below that on the balance sheet called mezzanine debt or convertible debt. How is the success of an LBO measured? Financial sponsors tend to measure their success by a figure known as the internal rate of return or the IRR. Many of them have a stated IRR goal, either stated or in mind, often around 30%. Such a statistic enables bankers to use an LBO analysis as a further valuation technique. The banker can use a target IRR and can then back into a purchase price in an M&A deal. We'll take a very close look at this in upcoming video modules. It's important to understand that IRR measures both the multiple of the return and the timing of the return. In other words, it's a measure of cash on cash, so if your money goes from 1 to 2, you've doubled your money, but IRR really does take into account how long it took to do achieve such a return. Let's look at the algebraic formula. I'm going to highlight this with my cursor. It's just present value times 1 plus the IRR raised to the holding period equals the future value. So in essence, the IRR is just a discount rate whereby your present value and your future value are equal, taking into account time. So I just define the abbreviations here. But for investments with multiple inflows and outflows, it might be easier just to use Excel's IRR function. But it is important for bankers to understand the math behind the IRR calculation. Let's consider a couple of examples. Think of a $10 million investment. If that $10 million turns to $25 million over the course of 3 years, we can calculate our IRR as 35%. And I just want to show that 10 million turning to the same amount at 2 years has a much higher IRR. So 10 million going to 25 in 2 years, IRR is 58 rather than 35. Likewise, let's consider the duration. 10 million turning into 100 million sounds like a great deal, but if it takes 10 years to get there, a sponsor may not be as enthusiastic with an IRR below 26%. Let's consider the effects of leverage on returns. In an LBO, there's two primary ways that debt is used to boost returns. First way, the cash generated by the business can be used to repay debt. So let's think about a $100 million LBO, and it's financed with $40 million of equity and $60 million of debt. And let's assume the business, over the course of 2 years, generates $30 million of excess cash. The management at the business, in conjunction with the sponsors, decide to use that $30 million exclusively to pay down debt. So there's no change in the value of the business over those years. Let's assume it's not growing or anything. Simply by repaying debt and keeping the enterprise value constant at $100 million, the equity value grows to 70 while the debt's reduced to 30. So we can calculate an IRR. Growing our 40 million of equity to 70 million over the course of 2 years is an IRR of 32%, but it's important to note this IRR is earned while the value of the business hasn't changed at all. So the business growth is 0, and there's still a very attractive IRR here for a financial sponsor. The second way that debt can be used to boost returns is by using cash generated by the business to grow the business. So let's consider that same $100 million LBO, 40 million of equity, 60 million of debt. Same business, it's generating 30 million of excess cash in 2 years. But instead of paying debt down, we just leave the debt constant, and we can use that cash to grow the business. And let's just assume each dollar used grows the business by $1. So the TEV grows from 100 to 130 million. Debt stays constant at 60 million. And just like before, the equity value has grown to 70. So in this case, we have the same IRR, 32%, because our equity investment is growing from 40 million to 70 million. And we actually are boosting the enterprise value of the company, but the IRR is the same. IRR is independent here of debt. And we're going to take a very close look at this with some future modules as we build and evaluate an LBO transaction. Please join us.